What if the financial freedom you believe you have was never real to begin with? What if every choice you make with your money is already predicted, confined, and redirected by a system designed long before you were born? A system so deeply embedded into modern economies that most people will live and die without ever noticing it? This hidden structure did not emerge by accident. It was engineered through centuries of monetary manipulation, political influence, and deliberate concentration of financial power. And once it was installed, it began shaping the boundaries of individual freedom, determining who prospers, who struggles, and who never gets the chance to rise. For generations, the narrative has been that you are in full control of your economic life. Earn, save, invest, spend. But behind this comforting illusion is a network of mechanisms that quietly directs your decisions. Interest rates, inflation cycles, debt expansion, credit dependence, centralized monetary authority, and global financial coordination are not neutral forces. They are tools crafted to guide behavior, limit alternatives, and create a predictable flow of wealth from the many to the few. When you look closely, the pattern is unmistakable. Every major financial shift in the last century, every crisis, every sudden scarcity, every boom that favors some while destroying others, ties back to the same architecture. The most unsettling part is how subtle this system is. It does not demand your obedience with force. It shapes your habits with incentives. It restricts your options with structure. It influences your values through economic pressure. By the time you realize your choices were never entirely yours, the boundaries have already closed around you. And once you understand the historical roots, it becomes clear that this was always the goal. Nothing in this system is random. Nothing is neutral. Every component was placed to ensure that financial power remains predictable, centralized, and perpetually reinforced. And as you recognize these patterns, you may start questioning moments of your own life when something felt off, when your financial options seemed strangely limited, or when the system pushed you in a direction you never fully agreed with. Have you ever felt that invisible pressure, that quiet force shaping your decisions? If so, share your experience below, leave your comment, make sure to like this video, and check if you are already subscribed, because what you are about to discover may change the way you see every financial choice you have ever made. And it leads directly into the next part of this story, where the true origins of this system begin to reveal themselves. To understand how this hidden system took shape, you have to go back to the moment money stopped being a simple tool for trade and became a mechanism of control. The earliest architects of financial power understood something that ordinary people did not. Whoever controls the rules of money controls the behavior of societies. And this realization didn't emerge suddenly. It grew gradually, through centuries of experimentation, political crises, and strategic decisions disguised as reforms. What began as small adjustments to stabilize economies eventually evolved into the foundation of a structure capable of guiding entire populations without ever raising suspicion. At the root of this transformation were governments facing constant financial pressure. Wars, expansions, public debts, and economic instability forced rulers to look for new ways to generate resources without depending solely on taxation. That was the opening. Financial elites, merchants, and early bankers stepped into this vacuum offering solutions that appeared beneficial on the surface, but fundamentally shifted power away from the public. Lending to governments became a privileged pathway to influence, giving financiers both leverage and protection. The moment rulers accepted permanent debt, the balance of power began to tilt, almost imperceptibly, toward a class of individuals whose influence did not come from votes, land, or armies, but from the ability to create and manipulate economic lifelines. As decades passed, these mechanisms grew more sophisticated. Currency became less about intrinsic value and more about promises backed by institutions. Governments embraced policies that increased dependence on credit, setting the stage for future generations to be born into economic frameworks already shaped by unseen hands. Slowly, predictably, money ceased to be an expression of productivity and became an expression of control. It defined access to opportunities, dictated social mobility, and determined who could build stability and who would remain trapped in cycles of debt. Every innovation in monetary policy, Every shift in national finance, every structural reform presented as progress, had an underlying effect. The public's autonomy narrowed, while institutional power expanded. This was not immediately visible because each change was wrapped in technical language, sold as necessary for stability or modernization. By the time the system fully matured, people no longer questioned its foundations. They accepted inflation as normal, debt as unavoidable, and centralized monetary authority as unquestionable. What emerged from this long historical process was not just an economic structure, but a psychological framework. People learned to trust the system even when it failed them. They learned to interpret scarcity as personal failure rather than structural design. And as generations passed, the true origins of this financial architecture faded into obscurity, leaving behind a population navigating rules they never asked for, shaped by forces they were never meant to understand. As this system evolved, it entered a phase where its creators no longer needed to justify its existence. They only needed to refine it. What had begun as a series of financial innovations slowly turned into a coordinated framework, capable of guiding entire economies with subtle adjustments. The shift from tangible money to abstract value marked a turning point. Once currency detached from physical constraints, it became infinitely moldable, shaped entirely by those with the authority to define its rules. This transition opened the door for a new level of influence, one where financial power was no longer limited by gold or silver, but only by the imagination of the institutions shaping policy. Centralization became the key. Decision-making that once belonged to local economies or diverse groups of merchants moved into the hands of a small circle of financial authorities. These institutions didn't need to impose control directly. They only needed to create the environment in which control naturally emerged. Interest rates became psychological tools as much as monetary ones, guiding behavior by encouraging spending or suppressing it. Inflation was no longer a byproduct of mismanagement, but an intentional component, shaping expectations and conditioning people to accept that money would constantly lose value, pushing them towards systems that generated profit for those at the top. Behind each of these refinements was a deeper logic: predictability. The more predictable a population's financial behavior, the easier it became to steer. Economic incentives were crafted not merely to support growth, but to maintain a cycle where citizens remained dependent on credit, accustomed to rising prices, and encouraged to measure their progress through systems engineered by institutions rather than through genuine financial autonomy. Over time, this conditioning created a population that could be guided with precision simply by adjusting a few economic levers. What made the system even more resilient was the appearance of legitimacy. Complex terminology, academic theories, and layers of bureaucratic sophistication gave the impression that these mechanisms existed only to stabilize economies. Public trust grew not because people understood the system, but because they were overwhelmed by it. When something seems too technical to question, it becomes easier to accept. And with each generation, the gap between those who designed the financial landscape and those who lived within it widened, leaving the public increasingly unaware of how deeply their financial choices were shaped before they ever made them. This refined architecture didn't need force or visible authority. Its power came from invisibility, from the quiet acceptance that the rules governing money were natural, neutral, and beyond questioning. But underneath that calm surface, the system was entering a new stage, one in which its influence would expand dramatically as global forces aligned to make the next phase of control appear inevitable rather than deliberate. As the system matured, it entered decisive turning points, moments when key players, often hidden behind institutional facades, made choices that permanently expanded their reach. These decisions rarely appeared dramatic to the public. They were presented as small technical adjustments, administrative updates, or necessary responses to temporary crises. But each one quietly shifted more power toward the financial elite, tightening the structure that would eventually limit the choices of entire populations. These were not accidents. They were deliberate moves, executed during windows of opportunity when people were too distracted, too uninformed, or too desperate to resist. One of the most significant patterns in these turning points was how they leveraged instability. Every economic shock, every banking failure, every sudden shortage created an opening. During uncertainty, people accept solutions they would normally reject. Financial authorities understood this well. Policies that centralized control, once impossible to justify during calm periods, became widely accepted during moments of fear. Institutions framed their expansions of power as protective measures, arguing that only a more unified, more controlled, more coordinated system could prevent future crises. And with that narrative, they gained support not because people trusted them, but because people feared the alternative. What makes these decisions so impactful is how seamlessly they were integrated into everyday life. New mechanisms were introduced with language that implied inevitability. Regulatory reforms were packaged as modernization. Structural changes were sold as progress. With each step, the system grew more sophisticated, allowing those at the top to guide currencies, influence markets, and steer national economies with unprecedented precision. The public, seeing only the surface, believed these reforms existed to protect them. Few realized that each adjustment narrowed their financial autonomy a little more. And while these changes seemed disconnected, in reality, they formed a chain. A new monetary tool introduced after one crisis became the justification for another expansion during the next. Temporary measures quietly became permanent. Emergency responses became standard practice. Bit by bit, the system's architecture shifted from reactive to strategic, from supportive to directive. By the time people noticed that their choices were shrinking, the framework had already solidified. These historical turning points weren't just moments of policy. They were moments when the architects of the system leveraged society's vulnerabilities to shape the financial landscape for generations. And once you recognize how these patterns unfolded, you start seeing how similar decisions continue to influence your reality today, shaping outcomes long before you're aware they exist. If you've ever felt affected by one of these quiet turning points, or noticed how a crisis suddenly reshaped financial rules in ways that limited your options, share your thoughts in the comments. As these turning points accumulated, their impact on ordinary people became increasingly invisible, yet deeply personal. Most individuals never trace their financial struggles back to decisions made decades earlier, far from public scrutiny. Instead, they internalize the consequences as private burdens: the rising cost of living, the shrinking value of savings, the pressure to rely on credit for even basic stability. But beneath these individual experiences lies the core effect of the system itself. It quietly narrows financial pathways, creating a world where people believe they are choosing freely, even as the range of available choices has been strategically reduced. This process operates subtly. Inflation, for example, isn't just a number. It shapes behavior. When people expect their money to lose value each year, they become more dependent on systems built around borrowing and spending rather than saving and building independence. Meanwhile, access to credit becomes both a lifeline and a leash. Credit scores, loan structures, and interest cycles are framed as neutral instruments, yet they are designed in ways that reinforce dependence. The more someone needs credit, the more influence the system has over them, guiding not only what they can afford, but how they view stability itself. Over time, this conditioning reshapes aspirations. People stop aiming for long-term ownership and instead settle for short-term survivability. Homes become harder to buy. Renting becomes the norm. Education becomes too expensive to pursue without decades of debt. Healthcare becomes a financial risk rather than a guarantee. These are not isolated problems. They are symptoms of a framework that ensures individuals remain plugged into the mechanisms that maintain institutional power. Even choices that appear straightforward are influenced by this structure. Investment options, retirement plans, insurance products, and banking services all operate within pre-designed boundaries. People are offered a curated menu of financial paths, each one subtly aligned with the system's interests. True autonomy, building independent wealth, escaping cycles of debt, or stepping outside institution-approved financial channels, becomes not impossible, but intentionally difficult. Most never attempt it because they've been immersed in a world where these limitations feel natural. And as generations grow up within this environment, the boundaries harden. What once felt restrictive becomes normalized. People learn to justify the system's demands, internalizing its pressures as personal shortcomings instead of structural design. The system doesn't need to enforce compliance when individuals believe the constraints are simply part of modern life. This quiet, pervasive influence is what makes the architecture so enduring, shaping not just financial decisions, but the mindset through which people understand opportunity, risk, and the meaning of progress. As the system tightened its influence over individual financial life, a new mechanism emerged to reinforce its power: engineered cycles of crisis. These crises were never presented as intentional, yet they consistently produced outcomes that strengthened the same institutions responsible for shaping the economic landscape. Each collapse, each recession, each market shock became an opportunity to consolidate authority, expand dependency, and reset the rules in ways that left ordinary people more vulnerable than before. Behind every major downturn, regardless of its cause, the pattern revealed itself with striking clarity. Crises create urgency, and urgency erases resistance. When markets tremble, when savings evaporate, when institutions appear at risk of failure, the public becomes willing to accept interventions that would have been unthinkable during stable periods. The system uses these moments to introduce sweeping financial measures disguised as rescue operations, emergency lending facilities, new regulatory powers, rapid expansions of monetary intervention, all of them framed as temporary necessities, yet many quietly transition into permanent tools of control. The cycle repeats, chaos erupts, institutions intervene, and their influence deepens. These events don't just reshape the financial landscape from above, they alter behavior from below. Families that lived through one crisis become more risk-averse, more dependent on institutional guarantees, more willing to trust authorities out of fear of repeating past losses. Businesses restructure around new policies, adopting models that favor compliance with centralized systems. Investors learn to treat interventions as predictable signals, reinforcing the idea that markets no longer move freely, but respond to the expectations created by those who oversee them. Over time, crises become part of the system's design rather than disruptions to it. Debt plays a crucial role in this cycle. Each crisis often leads to an explosion of public and private borrowing. Governments take on new debt to stabilize economies. Corporations borrow to survive downturns. Individuals turn to credit to compensate for lost income or eroded savings. Once the crisis subsides, the debt remains, anchoring every layer of society more firmly to the institutions that manage the flows of money. With each repetition, the system gains additional leverage, not through direct force, but through a growing web of obligations that redefine what financial freedom even means. What makes these engineered cycles so effective is how they blend inevitability with opportunity. The public sees only the surface, a crisis that must be solved at any cost. But underneath, the system uses each shock to refine its architecture, eliminating alternatives and strengthening the pathways that lead back to institutional control. What began as a response to instability gradually becomes a predictable component of the structure itself, shaping expectations and guiding behavior long after the crisis fades from memory. And in this evolving environment, the next stage of consolidation begins to take form, reshaping the very idea of economic autonomy in ways that most people never recognize until the effects are already woven into their everyday lives. As these crisis-driven mechanisms became embedded in the financial landscape, the system entered a phase of consolidation unlike anything seen before. What had once operated through regional structures and national policies began to merge into a global architecture, coordinated through institutions that presented themselves as stabilizing forces but functioned as the final layer of control. This shift didn't happen overnight. It unfolded through decades of policy alignment, international agreements, and the rise of financial entities whose influence extended far beyond the borders of any single country. The result was a structure that could guide the world's economic direction with extraordinary subtlety and precision. Globalization played a pivotal role in this transition. As markets opened and capital moved freely across continents, the boundaries that once protected nations from external financial pressure weakened. Monetary authorities and international organizations gained new opportunities to shape policies in ways that aligned with their long-term objectives. Central banks adopted similar frameworks, financial regulations became harmonized, and trade agreements quietly built pathways for uniform economic behavior. What appeared to be an interconnected global economy was, in reality, a unified system operating under shared rules created by a small circle of decision-makers. Technology accelerated this transformation. Digital banking, instantaneous transactions, and algorithmic systems created an environment where financial behavior could be monitored, predicted, and influenced with unprecedented accuracy. Data streams became as valuable as currency itself, allowing institutions to refine their models and anticipate public reactions long before individuals understood what was happening. With this information, the system didn't need to impose rigid restrictions. It could shape behavior naturally by guiding trends, controlling narratives, and adjusting incentives at precisely calculated moments. At the same time, the concentration of financial power increased dramatically. Fewer institutions controlled more assets, more information, and more leverage. Central banks expanded their balance sheets to historic levels, purchasing assets and influencing markets in ways once considered unimaginable. International bodies gained authority to dictate fiscal and monetary adjustments. Private financial giants accumulated enough resources to influence national policy from the shadows. Each layer interconnected with the others, forming a web so extensive that escaping it became not simply difficult but structurally impossible. In this consolidated environment, financial autonomy became a carefully managed illusion. People could move their money, invest their savings, or build their plans, but always within the confines of a system that had already predetermined the acceptable limits. Choices existed, but they were curated. Opportunities appeared open, but they followed pathways set long before individuals ever engaged with them. And as more of the system moved toward digital infrastructure, the level of oversight and influence expanded even further, shaping the future in ways that most people would never realize until the effects were already part of daily life. If you've ever noticed how the modern financial world seems increasingly coordinated, or how your options feel narrower despite more technology and more access, share your perspective in the comments. As the global system solidified, subtle indicators began to appear, signals that the architecture of control was no longer expanding quietly, but entering a phase of open reinforcement. These signs didn't come in the form of dramatic announcements or sweeping declarations. Instead, they emerged through policies framed as modern necessities, technological upgrades, or responsible fiscal management. Yet each one revealed a deeper truth. The system was preparing for an era where financial freedom would not simply be constrained by economic forces, but actively shaped by digital frameworks, regulatory structures, and global coordination. One of the strongest signals came from the rapid shift toward digital forms of money. While marketed as convenient and efficient, this transition represented far more than technological evolution. Digital financial systems create perfect traceability. Every transaction, every movement, every decision leaves a permanent record that can be analyzed, categorized, or restricted. This level of visibility gives institutions unprecedented insight into how people behave, economically, and therefore unprecedented leverage to influence that behavior. What was once an anonymous exchange becomes a trackable data point, feeding algorithms that refine the system's capacity to predict and guide financial decisions. Another signal emerged through the tightening of regulatory frameworks. Under the guise of preventing fraud, protecting consumers, or stabilizing markets, new regulations narrowed the range of acceptable financial activities. Certain investments became harder to access. Independent alternatives were pushed to the margins. Barriers increased for smaller players, while larger institutions gained more authority. What looked like incremental policy adjustments formed a clear pattern, a gradual funneling of economic activity into channels that the system could monitor, influence, or control with ease. At the same time, narratives around economic responsibility began to shift. Governments and institutions began promoting concepts that subtly aligned public expectations with systemic goals. People were encouraged to embrace long-term indebtedness as normal, volatility as inevitable, and institutional guidance as essential. Markets that once operated on competition and innovation increasingly relied on interventions from central authorities. The system was no longer shaped by natural economic forces, but by coordinated decisions that dictated its direction. Even technological integrations that seemed harmless contributed to this shift. Digital identity systems, biometric verification, and unified financial platforms offered convenience while creating an infrastructure capable of linking personal data, financial behavior, and institutional oversight into a single ecosystem. The boundary between personal autonomy and systemic influence grew thinner, often without the public realizing what had changed. With each innovation, the possibility of navigating the economy independently diminished further. These signs, taken individually, appear benign. But collectively, they reveal a clear trajectory. A financial environment where the illusion of choice becomes increasingly refined, while the underlying structure channels every decision along predetermined lines. The system no longer needs to hide its influence. It only needs to present each new layer as progress, guiding societies into a future where the boundaries of financial freedom are defined long before individuals recognize they exist. As these modern signals intensify, the long-term consequences begin to surface, revealing a future shaped less by individual ambition and more by systemic boundaries. What once felt like a gradual tightening of financial norms now appears as a generational transformation, one in which the very definition of opportunity is shifting. For many, the pathway to stability that previous generations relied upon, home ownership, steady savings, long-term planning, has become increasingly inaccessible. But beneath those visible struggles lies a deeper change. The realization that the next generations will inherit a financial environment where their choices have been predetermined by mechanisms they never agreed to and may never fully understand. This shift becomes most apparent when examining how economic expectations evolve. Young people entering the financial world today encounter barriers that are framed as natural outcomes of market conditions. Yet those conditions were shaped by decades of deliberate decisions. Rising costs are not simply the result of supply and demand. They are reflections of policies that inflate asset values. The scarcity of accessible opportunities is not the outcome of chance, but the effect of systems that reward consolidation and penalize independence. As a result, individuals grow up believing that financial struggle is a personal failure, rather than a structural outcome engineered long before they participated in the economy. These consequences expand beyond material limitations. They influence identity, ambition, and the concept of possibility itself. When the system subtly discourages risk-taking and promotes dependence on its own channels, through credit, regulated investment paths, or institutional retirement plans, people adapt without realizing it. They shape their aspirations around what the system allows rather than what they might have pursued in a genuinely open financial environment. Over time, this redefines the boundaries of imagination, making it difficult for entire generations to envision alternatives. The psychological impact is equally profound. The expectation of instability becomes normalized. People learn to anticipate crisis cycles, accept debt as inevitable, and trust centralized decisions even when they conflict with their own experiences. The result is a population conditioned to navigate financial pressure rather than challenge its origins. This conditioning ensures that the system remains self-reinforcing. Each generation becomes more integrated into it, more resigned to its limits, and more distant from the possibility of autonomy. Meanwhile, the institutions guiding this structure continue refining their influence. Data-driven decision-making, algorithmic oversight, and global policy coordination allow them to shape financial environments with increasing precision. This ensures that future generations not only adapt to the system, but become deeply embedded within it, living lives framed by boundaries set long before they were born. And once this intergenerational cycle becomes fully entrenched, the final stage of the system emerges. A stage where understanding the hidden architecture becomes the only way to navigate the world it has built. As this generational cycle deepens, the full picture of the hidden system finally becomes visible. It is not a single institution, a single reform, or a single figure pulling strings from behind a curtain. It is a structure built layer by layer, crisis by crisis, decision by decision, until it shaped a world where financial behavior follows predictable patterns, designed long before individuals ever take their first step into adulthood. What you experience as normal, rising costs, shrinking options, dependence on credit, perpetual economic pressure, is not a coincidence. It is the outcome of a framework that quietly governs the limits of your financial life, defining what feels possible and what feels out of reach. To recognize this, architecture is not to view the world through paranoia, but through clarity. The signs have been present in every stage of its evolution. The shift from tangible money to abstract value, the expansion of debt into a permanent feature of modern life, the crises that conveniently strengthen the same institutions each time, and the global alignment that ensures these patterns repeat across borders. Once you see how these pieces connect, the system stops appearing random. Patterns emerge. Decisions that once seemed isolated reveal themselves as part of a long continuum, each reinforcing the next, each narrowing the lanes through which financial freedom can realistically flow. Understanding this does not offer instant escape, but it offers something more valuable: awareness. Awareness allows you to step outside the illusion of randomness and observe how the architecture shapes incentives, expectations, and choices. Awareness lets you recognize when a policy that appears beneficial subtly restricts your range of action. Awareness gives you the ability to question narratives that discourage independence and reward dependency. And most importantly, awareness prevents you from accepting limits as natural when they were constructed with intent. This is why grasping the pattern matters. Not to fear it, but to navigate it. Not to submit to it, but to see where its boundaries lie and where your opportunities remain hidden beneath its weight. Because once you understand the design, you are no longer moving blindly within it. You are observing its rhythm, its motives, and its methods with a level of clarity that most people will never reach. And in a system built on the assumption that the public will not pay attention, being someone who sees the architecture is already an act of independence. If you reach the end of this journey and feel that this opened something in your mind, let me know by leaving the comment, "I'm seeing the pattern now." And if this kind of content helps you understand the world in ways most people never do, make sure to subscribe so you don't miss what comes next. Leave your like as well. It helps this message reach more people who are asking the same questions you are. And if you want to continue this exploration, there's another video right here that connects directly with everything we uncovered. Click and follow me there. The story continues.